In this class, we shall see what is insurance, history of insurance, what are the advantages of insurance. So, first of all, we shall see the history of insurance in India. In India, insurance was mentioned in the writings of Manusmriti, Yagnavalkya, and Kautilya's Ardhashastra. There are the three sources regarding the information of insurance. One is Manusmriti, second one is Yagnavalkya, third one is Kautilya's Arthashastra. These three books examined the pooling of resources for distribution after fire, for redistribution after fire, floods, epidemics, and famine. The pooling of resources were used for the unexpected contingent incidents. They are fire, floods, epidemics, and famines. The life insurance business began in 1818 with the establishment of the Oriental Life Insurance Company in Calcutta. In 1818, the Oriental Life Insurance Company was started in Calcutta, which started the insurance regarding the life. The company failed in the same that the Oriental Life Insurance Company failed in 1834. In 1829, Madras Equitable began before the closure, before the failure of the Oriental Life Insurance Company. Madras Equitable began conducting life insurance business in Madras Presidency. The British Insurance Act was enacted in 1870 and Mumbai Mutual 1871, Oriental 1874, and Empire of India 1897 were founded in the Bombay Presidency. All these companies were dominated by the British company. In 1914, the government of India began publishing insurance company returns. In 1912, the Indian Life Insurance Companies Act was the first statute regulating life insurance. This is the first statute, first act, which was made in 1912 that is Indian Life Insurance Companies Act. Indian Life Insurance Companies Act. In 1928, the Indian Insurance Companies Act was enacted to enable the government to collect statistical information about life and non-life insurance business conducted in India by Indian and foreign insurers. Indian as well as foreign insurers, including provident insurance societies. In 1938, the legislation was consolidated and amended by the Insurance Act 1938 with comprehensive provisions to control the activities of insurers. After the independence of India, the Insurance Amendment Act 1950 abolished principal agencies, but the level of competition was high and there were allegations of unfair trade practices. So, principal agencies were abolished in 1950 after our independence because of the unfair trade practices. The government of India decided to nationalize the insurance industry. The problems which were created by the principal agencies before 1950, and they were used to unfair trade practices. The government of India decided to nationalize the insurance industry. An ordinance was issued on 19th January 1956, nationalizing the life insurance sector. On 19th January 1956, Indian government issued an ordinance nationalizing the life insurance sector. And the Life Insurance Corporation was established in that year. In 1956, LIC was established and the LIC absorbed 154 Indian and 16 non-Indian insurers and 75 provident societies. The LIC had a monopoly until the late 1990s, when the insurance industry was reopened the doors to the private sector. So 1956 to 1990, LIC was the monopolistic institution in India. When in 1990, the insurance industry was reopened to the private sector. The IRDA opened up the market in August 2000 with an invitation for registration applications. Foreign companies were allowed ownership up to 26%. The authority with the power to frame regulations under Section 114A of the Insurance Act 1938 has framed regulations ranging from company registrations to the protection of the policyholders' interests since 2000. Yes. What happened in 1990? Doors were opened to the private sector in the field of insurance, so that some insurance companies made the investors to attract the policies, and thereby they were cheated by some companies. So there were some problems arisen between the 1990 to 2000. So IRDA was started in 2000 year to protect the policyholders, to protect the interests of the policyholders, and to register the companies at it. So it was an apex controlling body in India in the field of insurance. In December 2000, the subsidiaries of General Insurance Corporation of India were restructured as independent companies, and the GIC was converted into a national reinsurer. Parliament passed a bill delinking the four subsidiaries from the GIC in 2002. There are 28 general insurance companies, including the Export Credit Guarantee Corporation of India and the Agricultural Insurance Corporation of India, and 24 life insurance companies operating in the country. With the banking services, insurance services add about 7% to India's GDP. Yes, in 2013, IRDA attempted to raise the foreign direct investment (FDI) limit in the insurance sector to 49% from its current 26%. So the foreign direct investment percentage, that limit was enhanced to 49% in the year 2013. Earlier it was 26%. The FDI limit in the insurance sector was raised to 100% according to the budget 2019. Now, the present status of the insurance is there is 100% foreign direct investment permitted by the government of India in the budget 2019. Yes, now we shall see what is insurance. What is insurance? Yes, insurance is a legal agreement between the two parties. Insurance is a legal agreement, legal contract between the two parties, that is insurance company. Insurance company. The insurance company is called as insurer. And the person who have taken the policy are called, or the individual is called as insured. So there are two parties, insurer and the insured. In this, the insurance company promises to make good the losses of the insured on happening of the insured contingency. Yes. Insurance company guarantees, that means promises to make good to whom? To the insured, to the individual, or to the firm who insure. To make good the losses of the insured on happening of the contingencies, insured contingencies. So, insurance company guarantees, promises, assures to pay something financially to the insured one. It gives the guarantee, it gives the promise to pay something for the losses, to repay some in terms of financial to the insured one. Yes. The contingency is the event which causes a loss. Yes, damage. If it is caused a damage by nature, by theft, by anything else. So if it causes a loss, it can be the death of the policyholder or damage, destruction of the property, etc. It is called a contingency because there is an uncertainty. There is an uncertainty regarding the happening of the event. Yes. We cannot, nobody cannot expect what happens in future. We can't expect. There is uncertainty. So, contingency is uncertain because there is an uncertainty regarding the happening of the event. The insured pays a premium. Insured people, insured person, insured organization pays a premium. Insured thing by the owner pays a premium in return for the promise made by the insurer. For which purpose does the insured pay the premium? Which purpose? For why? Why should he pay? He pays the premium in return for the promise made by the insurer. Only for that he pays the premium. Yes. So, insurance is an arrangement with an insurance firm under which you pay them regular amounts of money and they agree to cover your costs if a certain unfortunate event occurs. Okay. So it is an agreement. It is an agreement between the insurance company and the insured one. What is the agreement? To pay the loss by the firm, insurance firm, and to pay the premium to the insurance firm by the insured. There is an agreement. There is an agreement between the two parties. One is insured, another is insurer. The insured pays premium and the insurance company or the insurer pay the compensation or loss for the damage, for the loss which is happened contingent. Yes. Insurance is an agreement with an insurance firm under which you pay them regular amounts of money and they agree to cover your costs if a certain unfortunate event occurs. For example, a traffic accident, damage to the property, or illness. Insurance, however, may also be arranged for a common event. If you reach a certain age, an event covered by insurance is referred to as an insurance event. Yes. The person to whom such an event occurs or may occur, it called the person insured. An insurance event occurs, you get ill, suffer an accident, reach a certain age. The insurer will pay you a certain amount of money referred to as an insurance benefit or claim paid. So, there are some happenings. One, getting illness, suffer an accident, reach a certain age. These are all the conditions. The insurer pay the insured a certain amount referred to as an insurance benefit or claim paid. The insurance benefit claim paid will help you or your family to overcome the financial difficulties or increased costs that may rise from an insurance event. This means that by arranging insurance, you obtain insurance cover against a certain risk, unexpected risk. Yes. Now we shall go further. As any other service, insurance is not provided free of charge. The insurer promises to pay you a benefit claim amount as agreed in the insurance contract. As we have seen earlier, it is a contract. So, in contract, insurer agrees you to pay something in the form of claim or in the form of benefit. upon the occurrence of an insurance event. The price you are to pay for the service is the insurance premium. For that service, you have to pay. The insured has to pay the insurance premium. The person who takes out an insurance policy and pays insurance premium is called the policy holder. Who pays the premium? Who pays the premium? Policy holder pays the premium. The insurance premium is payable in monthly. There are some options, methods, choices to the policy holder. Monthly, quarterly, or annually installments as a rule, but it may also be paid in a single payment. Yes, some policies are there. If we pay once, yes, it protects for some certain time which is mentioned in the policy. There is an option to pay monthly, quarterly, annually, or in a single payment or premium. Yes. How does it work? How does the insurance work? The insurance and the insured get a legal contract for the insurance, which is called the insurance policy. The insurance policy has details about the conditions, circumstances under which the insurance company will pay out the insurance amount to either the insured person or the nominees. Yes. See, it is a contract between the two parties. It is a legal contract which is called the insurance policy. The insurance policy contains the details about the conditions and circumstances under which the insurance company will pay out the insurance amount to either the insured person or their nominees, his nominees, her nominees. Yes, insurance is a way of protecting yourself and your family from a financial loss. Generally, the premium for a big insurance cover is much lesser in terms of money paid. The insurance company takes this risk of providing a high cover for a small premium because very few insured people actually end up claiming the insurance. Yes. If it is in long run, there will be a small premium and a few people may affect the risks so that they can pay the amount to them. So this is why you get insurance for a big amount at a low price. Any individual, company can seek insurance from an insurance company. But the decision to provide insurance is at the discretion of the insurance company. The insurance company will evaluate the claim application to make decision. Generally, insurance companies refuse to provide insurance to high risk applicants. Insurance companies refuse to provide insurance to high risk applicants. If there is any suspect, doubt, simply they reject their applications and they don't take such kind of insurances from the public. Okay, now let us discuss benefits and the importance of the insurance. Insurance, what are the benefits from the insurance? Insurance is a risk management tool, not only benefits the individual and businesses, but also benefits the society and the economy in numerous ways. Insurance not only benefits the individuals and also benefits the society and the financial development of the country. So, it is useful in many ways. Some of the important uses, benefits, advantages of the insurance are mentioned below. First one, provides peace of mind. Provides peace of mind. For example, you have manufactured very valuable goods and stored in a warehouse which is far away from your home. You are not there. You are not there. Your residence is very far away. Only one watchman may be there. But there may be a threat of thieves. There may be a threat of fire. There may be a threat of flood or anything other natural calamities. But if a weapon is there, that is insurance. If the weapon of insurance, that is, if insurance is there, if the goods are insured, our valuable goods which are in the godown or in the warehouse are insured, will be very free. Our mind will be peaceful. If anything happens, if any contingencies are happen, yes, insurer will look after. Not wantedly, but unexpectedly. Insurance provides protection against various uncertainties that can put you or your family in financial crisis. In the same way, regarding your family, your life insurance. Yes. If you are a driver or if you travel often all over the globe or all over the nation, if there is a chance of risks, in such situations, generally we take the policies so that we will be very free, because okay, we can't stop such kind of accidents, but in the part of our duty we go and do our duties in such circumstances. If anything happens, if any risk is happened, there is a weapon, that is of insurance. If we do the insurance, such kind of people will be very peaceful, who are exposed for risk. So insurance provides protection against various uncertainties that can put you or your family in financial crisis. By covering the uncertainties, the human life and businesses, insurance provides a sense of security. Yes. Generally, if we are secure, our mind will be peaceful. If we are unsecured, we always think for it. Insecurity. So, by covering uncertainties of human life and businesses, insurance provides a sense of security. Having life insurance gives you peace of mind that the financial stability of your family will remain intact even when you are not around. Having health insurance gives you a sense of security that you do not need to shell out all your savings in the event of medical emergencies. And even other goods insurance also put your mind in the state of peace. So the insurance provides the people to be in peaceful manner for future uncertainties, promotes risk control. As insurance works on risk transfer mechanism, it promotes a risk control activity. Yes. It controls the risk. It protects the risk. It protects from the risk. So it is an equipment. That means it is an instrument to control the risk. Promotes economic growth. As insurance funds are invested in various projects. For example, we have to think the premiums which are collected by the insurance company, or generally yes, promotes economic growth. Generally, the premiums which are collected from the insured people, which become the huge amount to the insurance company, will be invested in other companies, shares, debentures, or they give the loans to the needy institutions. So that amounts leads to the economic growth of the country. As insurance funds are invested in various projects like water supply, power and roads, etc., it contributes to the overall economic growth of the nation. Also, insurance provides employment opportunities to the people. Yes, it provides employment. If these amounts are invested in the companies, in the firms, so that the employment generation happened naturally, automatically. So it gives the boost for the employment to the people. Insurance contributes to the economic growth in many other ways, such as getting foreign direct investments, paying taxes on profit earned by investing in the capital markets, etc. Yes. Now let us see distribution of risk. Distribution of risk. So, risk is distributed on various individuals or organizations. The persons, people, or organizations who do the insurance may not exposed to the risk. A few will be affected by the risk, by the contingencies. A few will be paid. So risk is borne by the all. So risk of insurance is spread across various individuals and organizations. Instead of concentrating on only one. So not concentrating on one, but it is distributed among all the insured. Helps to get loan facility. Yes, insurance, the persons who take the policies, insurance policies, may get the loans on insurance policies. There is a chance to get the loan on the policies. It inculcates saving habit. It inculcates saving habit among the people or organizations. There are many life insurance products that come with investment, come protection benefit. So recently, most of the insurance companies have been introducing the plans, policies, investments, as well as protection benefits. Such insurance products inculcate a regular saving habit among the individuals. Plans like endowment insurance plans helps in achieving long-term financial goals. And it last provide tax benefits. Yes, as we have seen, if we invest the amounts by the insurance companies in some other companies, so that taxes are pooled, paid by the such other companies to the government, so that the income is generated. Now, provides tax benefit to the policyholders. This is another benefit to the individual, to the organizations. Insured gets the tax benefits for premium paid depending on the insurance product type. For example, the premium paid towards life insurance plans qualifies the tax reduction under Section 80C of Income Tax Act. Yes, there is a tax reduction for the paid insurance premiums. And the premium paid towards health insurance plans qualifies for tax reduction under Section 80D. If the policy is taken regarding the health insurance, it can be deducted under Section 80D of the Income Tax Act. So, there are tax benefits to the insured people under Section 80C and for the life insurance, and under Section 80D for the health insurance. So it is a benefit to the policy holders.